Here are 3 reasons why to subscribe to Fringe Financials on YouTube. Number 1, it is free, which is the best price that you can pay for this kind of content. 2, I am completely transparent with all of my investments. And number 3, I have a variety of educational videos every single week. Now let's get on with the video. What is up, YouTube, and welcome back to another Fringe Financials video. In today's video, as you can see on my screen, we are breaking down my options trading strategies on my Robinhood account. As you can see right here, this is in fact my position I have right now. It is after hours currently, so my position is trading a little bit. But in today's video, we're going to talk about my options trading strategies, how I trade options, what I'm doing, the probability, the calculations, and everything you need to know about options trading. This is one of 2 videos that I'm doing. Today, I'm going to go over the basics of trading, and the next video that I'm going to have a little bit later on will be about a little bit more of an advanced trading system. So if you're excited for today's video, make sure that you smash the thumbs up button, subscribe to the channel if you've not already done so, and turn on the bell notifications for all future uploads. Now, first thing, before anybody says, oh my god, you have Robinhood Gold? Yes, I do. It was free for the first month, $5 per month, and I've already accrued almost $5 back in just interest. And these are a little more in-depth analysis on certain stocks, so I kind of like it. Again, you need to have some cash in your portfolio waiting to be invested, like I do right now. So it's kind of earning me a little bit of interest to pay for Robinhood Gold as I wait for my next position. So with my options strategy here, this essentially is going to be a breakdown and a walkthrough as to how I'm trading options. Okay, so my portfolio is sitting at currently $34,428. And as you can see over here on the top right, I have a DraftKings option that I'm currently selling and a Tesla call option that I'm selling as well. Now, if you've seen it on Instagram, my Tesla call position that I am selling right now, it's dated until January 17th of next year, not like the 2024, but 2025. So that's more of just to cover my bases in case, something was wrong with Tesla. I can make some more money on it and everything else. But, you've seen enough videos about Tesla. I'm done with talking about Tesla for now until something crazy happens. Let's show you what I'm doing in my options trading strategies here. So essentially what the strategy is on this portfolio is to focus on selling options. Okay. So if you've ever heard about options trading strategies or, how I trade options, I made a video about it previously that's, again, you can go back and watch as well. I'll have it linked up top somewhere at some point in the video. The idea behind option selling is that it puts the advantage on you. It puts the probability, it puts it in your favor. Whenever you're selling or buying options, right, there's always a buyer and a seller. Just like when you go to the store and you go to buy something, you're buying someone's product that someone is selling to you. So in options trading with stocks, you are buying a contract from someone who is selling it. The seller is always going to be me in this scenario, and then you would be the buyer. Essentially what it is you're both having this contract, and the contract is equivalent to 100 shares. So what it does is it leverages your portfolio by giving you access to 100 shares without having to buy 100 shares and owning 100 shares of the stock. Okay, so options trading, again, is risky. Again, this is not financial advice. I am not a financial advisor, as you already know on the screen. But basically, options trading is a risky thing to do. You have to play the numbers carefully and to manage the portfolio and manage your trades. Otherwise, things can go south and you can have a huge drop-off. You probably see it in my position here. I had a huge drop-off down here and it recovered a little bit, which has been great. But again, that's just because mostly this option right here is currently down like $2,000. But I'm not going to tell you about that for right now, obviously. So anyways, so the idea behind option selling is that you're the one selling the contract to somebody else. So let me give you an example about how I look at a stock, about how I'm going to trade it, and what I look for, and how to actually open up selling a contract or selling, against a stock, whatever it costs to be. So for example here, I've been watching the company XPeng Incorporated. They're an EV company based out of China. They're one of Tesla's leading competitors, and we're not cover both Tesla and XPeng in this case here. The first and the most important thing to understand about this strategy here is you have to pick stocks that you are willing to own. Long-term, short-term, whatever it is. If you're trading stocks that you don't want to own, you should not be doing this strategy right here, because that is where, you get in your head a little bit, you freak out a little bit, you make decisions that are not clear, and you start to, go against your trades and everything else here. So as you can see, I've mapped out, a couple major levels for XPeng, as you can see here. And again, the key levels I look for, again, are things called support and resistance. Support and resistance basically talk about support is if a stock is bouncing at the bottom of a certain thing. That means you have a lot of support. You have a lot of people that are buying up a stock at a certain price. Resistance is just like the opposite. It keeps bouncing off the top and people are selling it. They don't think it should be going higher. So right now, as you can kind of see here, XPeng has been trading a little bit sideways, right? So it comes up, it retests. This is a support line right now. So it retests support, you get a little bit of bounce up. It comes into this resistance line about here, give or take, maybe a little bit more or less. And again, it comes back down, and then it bounces, and then it bounces, and it bounces, and it bounces. And you have the support, you have the resistance happening over and over and over again. As you can see here, we're getting a lot of support right here. Again, we're approaching this 1417 or this 1350 I have mapped out here. So basically, what my idea behind option selling is this. Again, it's basically like you're betting against something to happen to the company. So let's say, for example, I'm willing to bet based off of these patterns here, based off of these past historical bounces here, I'm willing to bet that XPeng is going to bounce again, and it's not going to go below, say, 350 or 1350, which is going to be a little bit, kind of move this down a little bit here. Let me try to see if I can move this down for you guys a little bit. Basically, I'm going to be willing to bet, I can even do 13 just because, just to make the point across here. I'm willing to bet that this white line right here is that XPeng will not go below $13. So with looking at the chart and watching how it bounces here, I'm willing to put my money into XPeng if it goes below $13. So you're making a bet, just like sports betting, just like you go to the casino. I'm making a, calculated, analyzed bet that XPeng will not trade below $13 for this white line right here. If XPeng goes below $13, I will be forced to buy the shares at $13. That's basically all it really is. Okay. In the simplest form, if it hits this price, I am going to be owning 100 shares of XPeng. Now, let me show you how to open up a position like this on a Robinhood account. Again, I can do a Webull video. If you guys want to afterwards, leave that in the comment section. Let me do a Webull video. I have a Webull position as well. So watch this. So here's my XPeng stock, which is going to be right up here. Here's the chart. And what I'm going to do is I'm going to go to trade XPeng options, which is the ticker XPEV. XPeng and then EV, 5 electric vehicle. So you click this and you get this a bunch of information here. And it looks very, very crazy at first. So you have a couple major things here at the top of the screen here. You have a buy or a sell. Just like I said before, you could buy an option, you could sell an option. So you have a buy and a sell here. You have a call and a put. Now again, call means that you're betting the stock's going to go up. Put means you're betting the stock is going to go down. So for this example, I'm going to bet it won't go lower than this. So it can go down. So I'm going to bet that it might go down, right? Which is going to be a put option, which is betting for it to go down. But I'm going to bet it won't go below $13 here. So I'm going to buy, or I'm going to sell, again, because again, we want to be the seller, not the buyer here. I'm going to sell a put option at the $13 strike price as you see right here. Again, this basically is when I click this is basically what it's going to be telling me is that I'm willing to bet that XPeng won't go below $13. Okay, that's my break even essentially, or that's my strike price. So if it goes all the way down to $13 right here, boom, again, this is when I get assigned my shares at the $13 mark. And then if it collapses even more, then I have more of a loss because it's below that strike price there essentially. Now, as you will see here, we have, again, what's called a premium. Basically what it is that I'm going to be getting, in this example, if I was to sell this option here, I'm going to be getting $11 for trading this option. So I'm going to sell this contract to a buyer. The buyer pays me $11 to own this contract. So I collect the money up front. He would be collecting the money a little bit later on if he chooses to sell his option afterwards. Okay. Now, as you will see up top here, I will not open this up because this is an 8-day expiration price or 8-day expiration on it. Here is your expiration dates. Again, you can go 15 days out. You can go 3 weeks out, 4 weeks out, 5 weeks out, however many days you want to go out. You can go a couple years out if you want to. And you pick a strike price. Now, as you pick a longer strike price that goes out, essentially what it does is that it gives more time for you to collect more premium. So for example here, say I want to go to the January 19th one, which again is about a month out from today. And I want to sell this contract of $13 strike price to a buyer. This is telling me the buyer is going to be paying me $50 up front here. And as you will see here, my max loss is $1,250. The reason why that's my max loss is Let's say that I get forced to buy XPeng at $13 a share. So that's $13 a share times 100 shares. Because again, these contracts are equivalent to 100 shares here. I'm forced to buy those 100 shares. Say I'm forced to buy $13 for each share, and it's 100 shares. That's $1,300. If XPeng goes to zero, I am out $1,300. But I keep this though, which is great. So again, that's why it's $1,250. I keep the premium, and I would lose everything else on the shares if it goes to zero. Which is why I say you've got to be trading options like this when you are looking at companies that you want to own, not ones that you're willing to, they are like super, super risky, right? So this is my idea behind it, essentially. Now, as I will show you with the math here, this is called a cash secured put. The reason why it's cash secured is that if you don't have enough cash to buy this contract here, if it goes to $13, you will be assigned and you will be in the negatives, and that's when margin comes into play here. I don't like playing with margin, which is why I like to do it with cash. So I'm keeping this much cash available because what that cash does is it's going to cover me if I need to buy the 100 shares at $13 each, which would be $1,300 total. I have $2,500 right now. So I'm in a great spot. I will be able to buy those shares out of those 100 shares and be good to go, right? So as you will see, again, this is called a cash secured put. And the reason why, again, it's because it's cash secured. The risk is minimum because you don't have to do margin. You don't have to take out a loan and buy the shares. You need to have the cash available for you to buy 100 shares of whatever stock it is you want to do. You want to do Apple, you need to have that much cash available to buy 100 shares of Apple. You want to do Google, same thing, XPeng, SiriusXM, whatever it is you're trading, you need to have the cash available to buy the contract in case it goes south. Okay, so say I want to do a cash secured put here. I'm going to do my XPeng stock, which is XPEV. And what I do here, this is how I show you what I track for my numbers here, because this really does allow me to understand my risk versus reward. Again, my goal with trading options is to outperform the S&P 500, which returns 10% a year on average. Again, this year, it's been a great year, but the year before that, it was down 20%. So your average is about 10% over the last 100 years. So what I put in the data here, so again, I picked the January 19th. I'm picking the $13 strike price for the put option. Again, I'm selling it right here. So as you will see here, when I do the calculation, again, I am getting $50 upfront, and my max risk, as Robinhood said, again, is $1,200. As you will see here, this is a very, very nice chart. And again, first of all, take a look at the profit, right? I have a 75.7% chance of it being profitable, which is more than 50%. If you go to a casino and you gamble blackjack, roulette, and everything else, all those games are in the house's favor. You are going to be winning less than 50% of the time on any casino game that you play. This basically puts me in the seat of the house of the casino, where I am going to be guaranteed profit a lot more if I do this trade over and over again with risk management. As you will see, as the time goes on here, as your time is moving here, this is where you get more and more of that premium. Because again, as long as it doesn't get close to that $13 strike price, as it's not getting close to this, you're getting more and more money here. That's your big, that's my, my strike price. That's what I'm getting assigned at. So as long as the stock is trading up here, I really don't care. And that is what I'm able to do. And this is why I like trading these kind of stocks here, because again, this is a 4% return in 1 month, right? A 4% return in 1 month. If I did this trade 12 times, I would make 48% in a year, which again is not realistic. I know that's going to crash and burn at times with these trades and everything else here. But my focus is that I'm looking to make trades that put me in the hands of beating the S&P 500. I don't want to take a trade that gives me like $5 on a premium and it gives me less than 1% return, or it's going to give me like 5% return in the year, right? So say, for example, I picked one for, I don't know, like next week out, right? And say I picked one that's like a super unrealistic break even right here. So like this one right here, this one's not even that bad, to be honest. This one guarantees a 99.7% chance of XPeng not going below $11, which is right here, right? Which is great. So it can't crash 22%. And again, this one gives you about 11% return, which isn't bad, but you're basically, you might as well put that money into the S&P 500 for the same return with a lot less risk. Again, options trading is a risky thing to do. It is not guaranteed to make money. You have to be very, very careful and do your research and do your due diligence and everything else. So back to what I was doing on Robinhood. Again, say I want to open this contract up, I would hit continue. As you will see, it'll say 100 shares. Again, one contract is equivalent to 100 shares. $50, which will be right here, is my premium. And again, you can set the credit. They have a 3 cents fee per contract, so it's $49.97. The market is closed right now, so I can't even open this up. You're going to hit review order. And again, as you will see here, it tells you exactly what you're doing. You are agreeing to buy 100 shares of this company at $13 on or before January 19th, 2024. If you aren't asked to buy, you'll keep your collateral and the full $50 in credit. Okay. What collateral is that they basically are now, if I was to open this trade up, they will take $1,300 of my buying power and put it on the side so I can't spend it. It's collateral in case something goes south. If this company goes below $13, they will pull my collateral and force me to buy the shares. That's what collateral is. Basically, you're pulling the money out of your buying power to have on the side in case you are forced to buy. That's what collateral always is. If this company doesn't trade below $13 by January 19th, they release the collateral and I keep the $50. And then I do it again. And then I do it again. And I do it again. And I do it again. Right? So that's what my options trading strategy is. Again, I'm not saying I'm a Wall Street expert here. This is just what I'm doing. And so far, I've seen quite a bit of success with things. Now, the nice thing about options trading is that you don't have to wait the whole time for it to expire. Okay? If you go back to my position here, so I'm doing one on DraftKings, right? So my DraftKings one is currently up $26. Again, so I'm gaining it because, again, I'm betting that DraftKings won't go below $33 right here. And since it's trading at $35 almost, again, as the time goes on, I collect more and more of the premium. The premium for this one is $68 right here. So as time and time goes on, I collect more and more. This number right here will get closer to this number right here until it expires on January 5th. But again, as you will see on the right-hand side here, you don't have to let it expire the whole time, right? You can hit view all options. Not view all options. We'll go back here. Okay. So you can basically buy to close it. Okay. What that means is that if you buy to close it, is that you are going to buy this contract back for $42. You're saying, but you're supposed to be making money, right? Well, if you buy it back for $42 and you made $68 from the initial payout from the buyer, again, you're collecting $26, which is the difference. So you don't feel like you have to hold these positions all the way until expiration. All right. Again, I'll give you an example. I posted it on my Instagram today. Again, @FridgeFinancials. Feel free to follow me down there if you haven't already done so. Roku, I made a trade yesterday, actually. Where was it? Right here. So here's my Roku trade right here. So I opened up this is a whole different trade. Obviously, this is a whole different video. But basically, I traded Roku and I made $34 in premium. I sold it I bought it back the next day to close the position, and I made $18, which again was $18 on $200 in collateral, which was 9%. I made 9% in one day. 19th, 20th, boom, 9%. I made almost the entire return on the S&P 500 in literally one day. Absolutely insane. So that is how my option strategy works. Again, you sell contracts to put yourself in a winning position, not in the losing one. You want to give yourself the best chance to keep the premium. And again, what I do is I make sure I have cash available to buy 100 shares of a stock in case something goes south. I hope this video helps you out with a little bit and you can see how it's going on Robinhood. Again, any questions, any comments, please make sure to leave them down in the comment section below. If you made it this far in the video, smash the thumbs up button, subscribe to the channel if you've not already done so. I hope you're making money in the market, and I will see you guys in the next video.